A stock market index is a statistical measure that represents the performance of a specific group of stocks within a financial market. It serves as a benchmark for investors to assess the overall performance of a segment of the market, an industry, or the entire stock market. Stock market indices are constructed using a weighted average of the prices of the constituent stocks, and changes in the index value over time reflect the relative performance of the underlying stocks. Here's how a stock market index works and how it reflects market performance. 1. Composition of indices. A stock market index is composed of a selected group of stocks that share common characteristics. Indices can be broad, covering a wide range of stocks, or narrow, focusing on specific sectors, industries, or market segments. 2. Weighted average. Each stock within an index is assigned a weight based on its market capitalization, price, or other factors. The weight reflects the stock's relative importance in the index. Larger companies or those with higher market capitalizations may have a greater impact on the index value. 3. Calculation of index value. The index value is calculated by taking the weighted average of the prices or market values of the constituent stocks. The formula may vary depending on the index methodology, but it typically involves summing the market values of the individual stocks with appropriate weightings. 4. Base period and base value. Indices often have a designated base period and base value from which the index starts. The base value serves as a reference point, and changes in the index value are expressed relative to this base value. The base period is a specific time frame chosen to set the initial index level. 5. Market performance reflection. Changes in the index value over time reflect the overall performance of the stocks included in the index. If the index value increases, it indicates that the underlying stocks, on average, have gained value. Conversely, a decrease in the index value suggests a decline in the average value of the constituent stocks. 6. Sectoral and market insights. Different indices provide insights into specific sectors or markets. For example, the S&P 500 is a broad U.S. market index, while the Nasdaq Composite focuses on technology stocks. Sectoral indices, such as the Dow Jones Industrial Average, may reflect the performance of specific industries. 7. Benchmark for investment performance. Investors and fund managers often use stock market indices as benchmarks to evaluate the performance of investment portfolios. If a portfolio outperforms its benchmark index, it is considered a positive indicator. 8. Diversification. Indices provide diversification benefits as they include a basket of stocks. Investing in an index fund or an exchange-traded fund, ETF, that tracks a specific index allows investors to gain exposure to a diversified portfolio of stocks. 9. Volatility measurement. Changes in the index value can also serve as a measure of market volatility. Sharp increases or decreases in the index may indicate periods of heightened market activity and can be used to assess overall market sentiment. 10. Global and regional indices. There are global indices that reflect the performance of stocks from multiple countries, as well as regional indices that focus on specific geographic areas. Examples include the MSCI World Index and the FTSE Europe Index. 11. Continuous monitoring. The index value is typically updated continuously during trading hours to provide real-time information on market performance. Investors and market participants closely monitor index movements for decision-making. 12. Influential economic indicator. Indices, such as the S&P 500 or Dow Jones Industrial Average, are considered influential economic indicators. They are often used by economists, policymakers, and analysts to gauge the health of the overall economy. 13. Custom indices. Some institutions create custom indices tailored to specific investment strategies or themes. These indices may focus on factors such as environmental, social, and governance (ESG) criteria or specific investment themes like technology or renewable energy. In summary, a stock market index is a tool used to measure and represent the performance of a group of stocks in the financial markets. It serves as a valuable benchmark for assessing investment portfolios, understanding market trends, and gaining insights into economic conditions. The movement of index values reflects the collective performance of the underlying stocks, providing investors with a snapshot of market dynamics.